welcome back to my YouTube channel. Today in this episode, I would like to talk about Guaranteed Rental Return Scheme, or some call it GRR in short, and how we can decode it. Under such scheme, basically property buyers are assured of rental income from developer for a certain period of time. However, as buyer, we need to be aware of the risks, as such schemes are not being governed by the Housing Development Act and the uncertainty with rental returns. As far as the Housing Ministry is concerned, these GRR contracts are between the buyers and the developers or their subsidiaries. It could be their hotel operators, service providers, etc. And the ministry has no role in regulating them. The aggrieved victim could not even file their case with the Housing Tribunal, as these cases are not within the scope and jurisdiction of the Tribunal for Home Buyers Claim. As GRR schemes tend to crop up during challenging property market, currently we are indeed in one, thanks or no thanks to Mr. COVID. Hence, in my opinion, I think it is timely for me to share this topic today with my subscriber as preventive measures to avoid any of you unwary buyers from falling prey into fake or bad GRR scheme in the near future. Thinking from my past experience as a property investor in Malaysia, I did indeed come across some genuine GRR deal before, but very rare. Instead, they are more of a fake or bad one in the market. So today in this video, I would share how I personally would decode a GRR deal to see if it is worth investing into, or should I shut it and run away like upon seeing a ghost. But first, let me explain what is a GRR. GRR is usually a scheme offered by developer for under construction project. Developer would promise to deliver a fixed rental return ranging anything from 8% per annum to 15% or some even higher to buyer over a specific period of time, let's say 3 years plus 3 years and etc. I would say genuine GRR schemes are best for laid-back investor as well as overseas purchaser. So now let us look at what is behind the scene. Usually the fixed return is already computed into the purchase price, exception unless it is a genuine GRR deal. Please remember that this guaranteed return is as good as the strength of the developer itself. So what must you consider? Firstly, as most GRR properties are often overpriced, so how do we filter out such fake and overpriced GRR deal? Easy. Compute the actual price by taking out the GRR returns to arrive at the net purchase price and ask ourselves if it is still a good buy. If yes, proceed to the next step, otherwise turn away from such deal. Secondly, what about the developer track record? How good is the developer in delivering its promises in the past project? A guarantee is only as good as the company that underwrites it. Even if the guaranteed return seems reasonable and is offered with honorable intention, investors need to be sure that the developer would be able to sustain the rental returns if the property market were to take a turn for the worse, like the past year and now. So it always pays to only buy from reputable developer with good past track record. Third, check that the rental rate in that area and compare with the GRR promise and ask yourself if it is achievable. For example, if the average rental yield in Batu area is about 6% per annum, but this developer is offering you a GRR return of 12% or even higher, this should have raised a red flag to you and ask yourself this: how is this developer going to sustain in giving up such high rental return to me over the medium to long run? Fourth, there must be real rental demand to substantiate the GRR scheme and making the GRR return sustainable over the long run. Do remember that a typical mortgage usually lasts for about 25 years to 30 years, and if you have a guaranteed rental for just the first 3 years, then what will happen to the remaining 22 to 27 years? If there is no real rental demand in that area, what would you do with the property once the GRR period is over? In areas of high competition, landlords will find themselves having to go on a price war just to attract the available limited tenants. Consequently, the market value of these properties will definitely go down rather than appreciate. So if you decide to sell off your unit, you will also be limited to buyers who will mainly be property investors only. Sellers will also find themselves competing not only with other sellers within the same high-rise, but worse, with other developers who may be offering even higher rental returns with newer development in the same area. Finally, always read the fine print. Ask if there is a legal contract for GRR and find out how many units within a high-rise is being offered with this GRR scheme. Imagine if the developer is aiming to offer GRR scheme for the whole block of the high-rise consisting of 500 units. This means 500 condominium units or apartments will be coming onto the rental market concurrently upon completion rather than a mix of owner-occupied. This kind of project, personally, I would avoid getting into. I prefer to invest into project with a mix of owner-occupier. Best would be 30 to 70 ratio or even lower, meaning 70% would be owner-occupier. Investor ratio should always be lesser than owner-occupier, and in this way, you will be facing lesser competition from investor alike in future upon completion of the project. Lastly, a wise investor should always check the small prints to look out for any hidden clause that may allow the developer to avoid paying the guaranteed rent. Remember that the terms and conditions in GRR agreements are not regulated by the housing laws. As such, inexperienced investors may not understand that the fine print is often written in the developer's favor. So it is always wise to seek out legal advice before entering into any GRR deal. To quote an example, one of the hottest GRR projects in Klang, launched by Boss in 2012, was found abandoned in mid-2014, which has victimized over 300 property buyers. The project was supposed to be a multi-million ringgit development. It was a high-rise residential hotel suite with commercial space by Hot World Developments in Berhad, and the units were sold between Ringgit Malaysia 250,000 and Ringgit Malaysia 900,000 back then. The aggrieved victim could not even file their case with the Housing Tribunal, as these cases are not within the scope and jurisdiction of the Tribunal for Home Buyers Claim. But you can take the developer to court if the amount of indebtedness is substantial and warrants a civil case against the party offering the GRR, which is the developer in this case. However, do note that the legal cost may be high and you may want to think twice about the worthiness of pursuing any legal action at all. From the past record, there have been a handful of cases over the years, but while some of these individuals won, these cases were against shell companies, hence these owners only won a paper judgment. And mind you, the paper judgment is not even tax deductible. What the fuck? So while some investors may approach the tribunal for consumer claims, but the total amount that can be claimed is only capped at Ringgit Malaysia 25,000. The tribunal is an independent body established under the Consumer Protection Act 1999 to hear and determine claims filed by consumers under the Act. So we have now come to an end of my sharing for today. If you have found value in this video, would appreciate to get a thumbs up from you, and remember to subscribe to my channel if you have not done so that you would not miss out on any of my future uploads. See you again in my next video, and as always, be aggressive in our learning, but be safe in investing. Bye-bye!